not only is inflation going to be much worse than everybody thinks, the economy is actually going to be weaker. Yes, people are factoring in a softer recovery because they assume the Fed raising interest rates will slow the economy. What they don't realize is that inflation itself is going to not only slow the economy, but potentially push it into recession. But to prevent that from happening, the Fed is going to ease further. So rather than tapping on the brakes, which is what everybody is bracing for, they're going to slam on the gas. They're going to put the monetary pedal to the metal, ignoring all the signs of inflation because they're worried about the economy. And the worries about the economy trump the worries about inflation. See, when it comes to the dual mandate, inflation always takes a back seat to jobs and the economy, and the Fed is going to admit that. And when it does, investors are going to have to come at this trade from a whole new perspective. They're going to be dumping US dollars, they'll be dumping long-term treasuries, and they'll be buying gold and silver. And in fact, one place that you can also see the fears in the market about the Fed having to fight inflation sooner than people expect and the negative impact that such a fight would have on the economy is in the reverse repo market. A lot of people have been emailing me or commenting on my videos, asking me to comment on what's going on in the reverse repo market. Because if you recall, something similar happened, I think back in 2019, when you saw a spike in interest rates that was a result of what was going on with these repurchase agreements. And that resulted in the Federal Reserve stepping up QE again in order to artificially suppress interest rates that were rising in the market. Well, the same thing is happening now with these reverse repos. What's going on is a lot of the big institutions that own a lot of short-term debt, let's say money market funds that have a lot of money invested in very short-term paper, they are deciding that they want more of that paper in U.S. Treasuries as opposed to in commercial paper or other liabilities of, let's say, the banking sector that are not direct liabilities of the Fed. Now, why is that? Well, because they want to take less risk. If you're loaning money to a private corporation or a bank, obviously you have the risk of default. You don't have that risk in theory if you loan your money to the U.S. government and it's sitting in T-bills at the Federal Reserve. So what's happening is more and more of these money market portfolio managers are opting to reduce the risk of their portfolio by concentrating more money in treasuries. Now, why would they be doing that? Well, if they are looking for the economy to slow down because the Fed now has to start to tighten sooner, well, a slowing economy means companies have less revenue. Well, if companies have less revenue, maybe they can't afford to pay the debts that they've borrowed. And so in a weaker economy, you have a higher likelihood of default. And of course, if you're owning the paper and it went into default, well, that's a loss. So why not get rid of it? Now, normally what would compensate a lender for the added default risk of holding, let's say, corporate commercial paper or financial paper issued by banks rather than holding T-bills is, well, you get more interest, right? You get an extra return for taking that additional risk. And even though there is a little bit of an extra return, it's not worth it. The yields are still so low that the incrementally higher yield that you get by taking some default risk isn't worth taking the risk. So everybody is saying, I'm just going to play it safe and I'm just going to put all this money over with the Fed. And so now the Fed is doing all these repo agreements, reverse repurchase agreements, because there's all this extra demand for treasuries over corporates or liabilities of the banking sector. And this is a problem because it is taking reserves away from banks. It's taking funding away from the corporate sector, therefore putting upward pressure on rates in order to try to get that money back so that they could use it and lend it into the economy. And of course, as those spreads start to widen, that is a bigger problem for the economy, for the stock market. And again, what investors are missing is the Fed is not going to sit back and watch this happen. They are going to take action just like they did in 2019 to try to reverse this. So what do they have to do? They got to print more money. They got to get more money into the banking system to replace the money that's being sucked out because lenders are too afraid of defaults in a weakening economy, and they expect the economy to weaken because they expect the Fed to raise rates. Well, the Fed needs to reverse those expectations. It seems obvious to me that the Fed now has to do damage control from the fact that it talked about tapering, and it has to reassure people in even stronger terms that it ain't going to happen and that it doesn't matter what's happening with prices. They're not going to contain it. Even if it isn't transitory, it's okay. Higher inflation is not that big a deal. In fact, that's what Janet Yellen has been saying. I talked about that on an earlier podcast. Janet Yellen used to be the chairman of the Federal Reserve. Right now, she's Secretary of the Treasury, but she is now saying that more inflation is a good thing. If the result of our fiscal policy is that we have higher inflation, well, that's great. That's just a bonus. That's a twofer, right? We get to help the economy and we also get higher inflation. So she's saying inflation is a good thing. Is it a stretch that if the former Fed chairman can say inflation is a good thing, why can't the current Fed chairman say the same thing? Especially when that message is so self-serving, because if they admit it's a problem, well, they have to do something about it. They can't do something about it, and that's the bigger problem, so you have to pretend. Right? I've used this analogy before, and I forget who first said it, but if you're being run out of town, what do? You jump to the head of the line and pretend like you're leading the parade, right? That's what they have to do. The Fed has to lead the inflation parade by pretending it's a good thing. But that is the beginning of the end of the dollar. Because once the markets realize this, and they should already realize it, I've realized it for a long time. That's why I've been getting out of the dollar. That's why I own gold. But when the markets finally come to terms with this reality, that's the beginning of the end, and you start to see the dollar implode and gold take off.